Sell everything, says RBS. The bank is advising clients of a, quote, cataclysmic year, according to the Telegraph, which says RBS is citing a deflationary crisis that could wipe a fifth off major stock markets and send oil as low as $16 a barrel. The lender adds, quote, in a crowded hall, exit doors are small. Stuart Richardson is with us, partner at RMG Wealth Management. Stuart, I'm not sure you're going that far. It's not quite abandon all hope, but I think you probably agree on the line that there is safety, at least in bunds and treasuries at this point.
Agree with treasuries. I think bunds at 50 odd basis points. Maybe the price goes up a little bit, but it's not a particularly attractive starting point. I think if you're going for 5 or less year German government debt, there's a sort of sanity check involved if you want to invest in something with a negative guaranteed yield. So, I think you have to be even more selective than just saying core government bonds. US treasuries, I think, are representing a bit of value further out the curve, but then I think you have to have a bit of a view on both Fed policy, where the economy goes and so on. If you share the RBS view, then there's probably quite a bit of value. So we'll have to wait and see. Our sort of view is probably nearer to RBS and maybe the more bullish sort of crowd out there. In terms of Fed policy, we've seen an increased divergence between where the market's sitting in the last week or so and where the Fed is sitting. Last week, several Fed governors coming out trying to encourage the market to take the view there will be about 4 rate hikes this year, and the market's beginning to price out 2 and back towards 1. So we have had a continued divergence there, and I think the Fed's going to be sorely tested in Q1 and Q2 as to how far they can go this year.
Global oil prices have sunk to a 12-year low due to concerns about a growth slowdown in China, as well as a continuing global supply glut. This month's US benchmark West Texas Intermediate fell below $32 a barrel, its lowest since December 2003. Europe's benchmark Brent North Sea crude also slipped to $31.48 a barrel, the lowest since April 2004. Now, analysts say the price drop is mainly driven by worries over the grim economic outlook for China, which is the world's second largest consumer of oil. Investment banks Morgan Stanley and Goldman Sachs predicted oil prices could fall further, even further, to a range of $20 to $25 a barrel.
To Harry Dent, author of the book Demographic Cliff. All right, Harry, we know you're a bear. 2016. I couldn't think of a better debut for any of the bears out there. Has it followed the script, though, that you thought it would sort of follow?
Yes, it has. We've been warning that in the last year, especially on this show, that the market looked like it was topping. This is not a normal correction coming. It's another crash greater than 2008. Every crash we've had after every bubble has been bigger. We've been looking for the small caps to greatly underperform, and they're doing that in spades. Now that's the classic sign of a major top. The market's done very poorly in January and December, which are almost always the best months of the year. That's another sign of weakness, but we've most been warning people, watch oil. Central banks can control the economies in lots of ways, but they can't stop oil from bursting because it's coming from a global slowdown. And most importantly, look at China. China had a crash just like 1929, down 42% in just 2.5 months, and then the government steps in, like the U.S. government did in 1929, buys its own stock market with zillions of dollars and tries to stop the bubble from bursting, and 4 months later, bam. We're getting very close to that point. So China's following the same thing happened in 1929. I think within the next month or so, you're going to see China crash stronger, and the whole world's going to follow. It's just